Okay, guys, in the series of 10 important keys for the stock market success, the next important key is the fundamental analysis. Now, anything in the world, whenever any commodity in the world, when we buy, we check a lot of fundamentals about it. Then, why not about the stock market? And why not about the specific stock? So, fundamental analysis basically this helps in understanding the health of the company based on the financial statement. This also provides an insight in analyzing how effectively management is handling various aspects of the company. Now, some of the key ratios here and the key perspective from the fundamental analysis we are discussing, like the first one is earning per share. In short, it is called EPS. This EPS is one of the highly tracked ratio in the fundamental analysis. This is as per the from the financial statement how much each share is earning, that is net profit divided by number of outstanding shares of that particular company. So how much the profit is earned with respect to each share, and that is the EPS. Now, after calculating the EPS, the next point is next extension to the EPS is price to earning ratio. In short, it is called PE ratio. PE ratio is one of the prominent ratios used for the comparison of valuation of the stock. Now, what is this P? P basically tells us at what multiple of EPS the stock is being traded. That is the price of the stock divided by EPS divided by EPS. It indicates that how much multiple of EPS the current stock price is available. High or low P value should be compared with respect to its that particular industry. Also, it need to be examined along with some other factors mentioned in this series of videos. The next thing in the fundamental analysis is growth in EPS. Now, earning per share is good, but how that earning is growing year by year or quarter to quarter. So higher the growth of EPS indicates the company's profit margin is expanding, the company's revenue is expanding. So ultimately the profit of the company is going high and high with a specific rate. So higher the growth in EPS, the company will earn more premium or more price to earning ratio in that case. Now, next ratio here is debt to equity. Debt to equity is one of the very useful ratio in terms of how much company is having a debt and how much the equity company is having. So it is the ratio between these two. Ratio of total debt to equity indicates debt burden on the companies against the company's shareholder equity. This ratio also varies based on the nature of industry, but too much debt impacts profit of the company. Any company which is having very high debt should be thoroughly examined before investing in it. High debt may leads lot of issues with any organization if we do not look that into proper perspective. So understanding about the debt of the company is very important thing. Next, return on equity. It is a net profit divided by shareholders equity. This ratio helps us in understanding how much the shareholder earned for their investment in the company. So that is return on equity. Next is price to book value. This is useful ratio again in analyzing the net worth of the company. It is the stock price divided by book value of the company. Next ratio is the dividend yield. High dividend or low dividend need to be seen in a broader context. If you are investing in the growing company, expectation is company should use surplus for its growth and give higher return than the dividend. In other case, there is a surplus with the company and they are neither utilizing it and nor paying the dividend to the shareholders. So that is also not a very good perspective from the investor point of view. So in that case, the most preferred could be the companies which are paying continuously moderate amount of dividend and using the surplus for expanding the business. So this will be the combination of good consistent dividend along with the growth of the companies, which helps in giving the appreciation of the stock value. So these are some of the core fundamental aspect of the organization, though there are many other ratios than this, but at least these are the ratios one should know to understand how the organization is performing. Thank you.